Hello, everyone. Welcome to Quick Start Lab number, Corey, what number are
Number
we on?
5. I was just looking to see. Number 5, it looks like.
Number 5 for 2023. With Corey and I today. Noah, I don't know, he's kind of a snowboard skier, and we probably had 4 feet last night at the ski resort, so he's going to be in the powder, I'm pretty sure.
Yeah.
If
If he can
anybody
tunnel it,
is,
if he can tunnel his way all the way to the ski
if the
resort, that's
canyon's
going to be the
open,
hard part is getting there.
yeah, the canyon might not even be open, but
Right.
um, really fun. We've got a great quick start lab lined up today. Corey and I were speaking earlier this morning about some fun things just in preparation. And what a fun group, though. I mean, I just enjoy these live sessions, and it's just way, way fun. So, how's everybody feeling today? Morning, guys, from Palm Desert, California. Oh, Ron is always here. Ron is a staple, and so is Cleveland Lance and Lynette. V Chang, total staple, always showing up to class. He's from Taiwan, clear back from when I visited. Lisbon, Portugal, Toronto, Canada. There's Paul Bram from Iowa City, where I used to live. He's a Hawkeye.
Lynette's joining from her vacation. How about that?
Hey,
Tuning.
so I'm trying to find I'm trying to find a vacation spot for spring break, the
Well,
first week
she
of
says
April.
she says Hollywood, Florida is the place to be. So
Yeah, that wouldn't be bad.
that doesn't sound bad at all.
She's at the Hard Rock. Portugal. I've been so many places in the world, but I have not been to Portugal. Minneapolis, I could go from a little snow to a lot of snow. Well, no, from a lot of snow to a lot of snow, I think. Paul from Boston, not for vacation. I've been to Boston many times and I love Boston. Guatemala City, Madison, Wisconsin, nice little snowstorm. How much do you get up? You probably got more than me, Corey, but we've got about a foot last night and still snowing. So
Yeah,
a little over 12 inches here at my house.
I think it was about a foot and a half up here. It's pretty wild.
Go to baseball spring training, Switzerland.
In fact,
Oh,
my kids are at home. No school today. They're
no school.
doing.
We're getting soft, man. We're getting soft. Ever since COVID and they got all the remote learning going, it's like we get a little foot of snow and everyone thinks they can't navigate it. Come on, guys. Let's toughen up. We're playing basketball tonight. The state tournament starts tonight, so we're playing hoop no matter what.
Yeah.
There you go. Hey,
And
let's talk disclaimer and hop in. Good to
uh,
have everybody here. We provide information and education, not advice. It's particularly important in Quick Start Labs because we do some risky stuff. And people, the biggest thing I still worry about it as a teacher, I always worry about it, is people incorrectly perceive that I am magic or that Corey is magic, and they're like, well, if Corey's doing it, this is one of the reasons I haven't done a fund really. Is people have to have realistic expectations that you could have a down year. Like if I ever did a fund, if Corey and I ever did a fund together, we've talked about it. Is if you look at Warren Buffett, he had one year where the thing got cut in half, where all their holdings got cut in half. And for people, if they invest with Warren Buffett, all of a sudden you have to kind of share in his temperament, and you have to be prepared to have a year like that. And so part of being an investor is understanding how losses go and that they're going to happen in the ebb and flow, and that our belief is over time, it's better to own businesses than not. And that's really what it comes down to over time. It's better to own good businesses than not, but you're going to have ups and downs. So just because we pick one, we're going to pick a directional stock today, which this is a very small part of what I do. And it's fun to do once in a while. And there's a lot of reasons to do it and a lot of reasons not to do it. And so the trade's going to be really simple. The trade's going to take 30 seconds, but the context around it is what we're really going to be speaking about today. So my biggest fear is, well, shoot, if Andy and Corey picked it, it's got to be a winner. Nope, might not be. And the other thing I worry about is our track record in Quick Start Labs is extraordinarily good.
Yeah, too good. No,
Yeah,
it's not always that good. Yeah.
it's not always that good. And we've tried to be more aggressive this year so we could have some problems. So we'll start by reviewing Oxy that was threatening to give us problems and headaches to the upside. Now it's going to be threatening to give us headaches to the downside. And hopefully we can get a little more downside. It's not ready to talk about hedging it yet, but it's getting close. We'll look at those risk graphs. But the bottom line of the disclaimer is, and I feel, but yet, while I feel trepidation in the newbie thinking that we're magic just because we've done very well, I also feel a lot of confidence with this group because we have a lot of veterans, a lot of people who have been with us for a long time, and we just have great people and great temperaments. So you guys help me feel more confident and less fearful. So that's great. But this stuff is going to be risky. Let's just do a review of some of the trades we've did. Oxy, Noah visited and was a guest speaker. Did a little beta waiting and protected put stuff, and so we've got what six things going on here.
We've done quite a few things. So we kind of introduced, well, you could buy stock, and at the time Oxy was trading at 61.55, and just bring in dividends. That's just kind of, hey, I'm just going to play it where I own the stock, I collect the dividends. That's idea number one. Number two is trying to double your income, basically. We buy the stock. It's very similar. We still collect the dividends, but now we try to strategically sell some covered calls for income. Now, you have to know how to manage this in order to do this well. You have to know how to roll, how to hedge, how to do a variety of different things, or what's going to happen is you'll lose your underlying stock position at some point. You'll get called out. And that's not really our goal if we're an investor. So those are a couple of ideas where we can generate more income. Then we introduced the bull put credit spread, and we collected a credit for saying we don't think it's going to be below 55, but in case it is, we want to have some reinsurance. We want to have some protection, right? Then the next session, we added a bear call credit spread. We put the top side on, and we said, well, we don't think it's going to be below 55, but we also don't think it's going to be above 70. Yeah. And so we're going to do this spread, but we're going to buy the 75 call in case we're wrong. And we also got a credit for that one.
If I could comment on this, guys, hopefully what you guys see here is from pillar number 2, technical analysis. Is an entirely different thing to predict a range as opposed to a direction. How many have had that epiphany at some point in your training with us, either here or in years past, where you're like, my gosh, technical analysis is not just about picking up or down, as we're actually going to do today, but technical analysis can be about choosing a range and a probability range, which brings a new element that I believe is much, much, much easier and has a much high, gives us opportunities for much higher probabilities of being correct than the up or down. Is that a big epiphany for you guys? Most people don't get that, because when you go on CNBC or Bloomberg or Wall Street Journal, they're always talking about something going up, or they're talking about something going down. There's very little conversation to the idea of the range in which something might fall. And when you add financial education to the mix and a knowledge of constructing a trade like the bull put credit spread, and combine it with the bear call credit spread, or leave them isolated, any of the three, the bull put, the bear call, or together in the condor, any of those three are about ranges so much more than directions. And it is an eye-opener for most people, because it gives us an opportunity to be more aggressive and gain higher returns, but we get to do this within very high probabilities of success. We've had the market go up and down. This has been a wonderful season for Quick Start Lab, because in the past we have been, really bullish, really bearish. Today, this time Corey and I said it, I was slightly bullish. He said he was more neutral. It's not surprising that Corey's been more right than I have been, but both of us felt, more of a stagnation, in the range, and that's what we've tried to exploit this season. And so this idea of picking a range means that your market is always available for profits. You always have the chance in the market to accelerate what you're doing and attempt those trades. Up, down, or sideways, we really don't care. We'll adjust strategies, because no matter what the economy does, no matter what the stock market does, those opportunities present themselves. So I thought I'd interject that. I guess it's an obvious insight to many, but maybe not so obvious to some that are new, is the idea of gaining an options education and more specialty. It just gives you the opportunity to compound at greater risks and greater rewards and greater probabilities because of the idea of a range. So I thought I'd throw that in there.
Love it. And if you look at any stock chart, you'll probably notice that there are periods where maybe it's trending strongly up or trending strongly down, but you'll notice that it probably spends more of its time, and this is true of most any stock, more of its time within ranges.
Yeah.
It'll range bound trade for quite some time, and then maybe it'll break out and have sort of a strong trend for a little while, and then back to the range and back to the range. And it does that a lot, where as you look at the context of time, it's spending a lot more time within ranges than it is any sort of stronger trend environment. So very helpful to learn this style of trading. We also did protective puts, and we need to add another one because we bought the Oxy, the May 60 puts, which when we taught that, we said, look, the stock's gone up. If you owned either of these, the stock's gone up quite nicely. It was at 64 or whatever. We could buy protection, and boy, wouldn't that come in handy, because now the stock went from where it initially popped up. Now it's back down, and I want to say it's like at 58. So your underlying stock position in either of these two scenarios would currently be negative, but your protective put has gone up pretty nicely. And so if we look at that one, let's come over and kind of see how some of these things are going. If we just look at, did we have the protective put in here? I don't think I ever actually transmitted that for some reason, but let's come back over here and let's look at the May 60 puts, and those are going for about 550.
So you made money on those. Yep.
Yeah, so if you paid 335, they're going for about 550 right now. So that protective put position is at least making something. Now you might be net, you might be at a loss in those positions, but it's pretty good when your stocks go down if you've got something else going up on the other side of that, because we could lock in profits on this, and then our stock can rebuild itself, right? It can go right back up to 61.55 and 65 and 70 over time. So that's some strategy there. Noah and I, you missed it. We had a great time, but we certainly missed you, Andy. Last time we talked about hedging the portfolio from an S&P perspective using SPY. Basically, we did some beta weighting across SPY. We did protective puts with SPY, kind of saying, okay, we can buy a put across the portfolio. And if you look at this, I happened to transmit this, but we had to pay more than what we had analyzed because the market did gap down the next day. But look at our 400 strike put that we bought in April, and we paid $10. I think when we talked about it live in class, we were trying to pay $9, right? But the markets kind of jumped the other way, and we went ahead and bought it. We paid $10 for this put that has, of course, this risk graph that just keeps going and going and going in terms of profitability as SPY goes down. So SPY was up here in the 400s. Now it's trading down here in the just high 300s or so. And you can see that this April put, this 400 strike put that we paid about $10 for, if you just think about that put by itself, what is that put doing just by itself? Well, now it's worth, whoops, it's a long ways down here. The 400 strike put is going for about $12. So we put about $1,000 into that put to have some protection across the portfolio. Now it's worth about $1,200 in value. So that protective position is doing what it should be doing, right? The market's going down. This put, that causes put options to go up in value accordingly. So that's kind of a review of where we're at this point.
I think it's a great time to review some Greeks, and Sean Stone had a request, and I love these types of things. It can derail us a little bit, but I don't mind a little tangent because it's good stuff. But there was a request to talk a little bit about price slices, and I think the Oxy Iron Condor is a great opportunity to do that. Before we get into the price slices, what I'm going to do is give a quick review. Let me share my screen. Let's see, we want to go to screen number 2, show my screen. And that might take a little bit. I got a spinning rainbow. Let me know when you can see it.
Yep, good.
Okay.
Got it.
So the way we teach this is Ultimate Options Class 326. And by the way, by way of pitching an advanced class, how many of you have taken this and how many have not have taken the Ultimate Options course? It's rigorous. I mean, it's not for the faint of heart. It took my son probably 6 months to get through it, and he was, a full-time financial education student that year. So not yet. Some have started it. Yes, it's awesome. Ron LaFont has obviously taken it. Lance has taken it. People are planning it. Casey Plummer says he's loving it. Awesome stuff. Arena says let's see, enrolling in March. Fantastic. So some have taken it, some have not. Looks like Sean's about 2/3 through. So the idea of options is I talked about juggling these things, and I have them illustrated perhaps here as monsters. And you can see that some of them are more gestures and some of them are really scary. And you'll notice the one I have here that's the most scary is your delta. And here's the thing. Theta is going to run out. So this one is usually the one who is not that scary. You can certainly, if you buy your options wrong, I'll tell you where theta can get. And is it all right if I take this tangent, guys? I don't want to go too far from what Corey's doing, but if we're going to talk about price slices, it's not going to make much sense to talk about what price slices can do if we don't have a really, at least an introductory level understanding of Greeks. So we know that options have 3 components that can change their premium. Obviously, the time element is what you're buying when you buy an option. There's always an expiration date. You're buying time. Every contract seems to have a time element to it in our lives. LeBron James signs with the Lakers for a number of years. And when that time runs out, the Lakers are left with having to renegotiate and do a new contract because that one now is expired. LeBron is also faced he's out of time now, so he has to decide what he wants to do. In real estate, I have, the contracts I'm engaged with are for time. The tenants in the real estate, most of them are on a monthly, where they pay for a month to month, and so it's time they're buying in the house. They're not actually buying the house, you're buying time. Well, in an option, you're actually not buying the stock, you're buying time to make a choice. You're just buying yourself time to keep your option open, to keep an ability to buy. So, a person could wind up with a theta problem if they buy an option and they don't buy enough time in it. So think about it this way, and this will go back to 4 pillars. Let's test you guys on your 4 pillars knowledge. I did this with my son the other day. We were driving and just testing him on his 4 pillars. My older son has been through all of our classes. My youngest son is still in 4 pillars this year in his financial education year. So I said, David, if you were at the grocery store and you were a seller of milk, and you had several shipments in with different expiration dates, which milk would you put in the front row of the aisle first? Would you put the milk with expirations that were proximate or expirations that were distant? So you guys can answer that question in the chat. Right, you want the ones that are going to expire first if you're a seller, because the time's killing you, right? You're running out of time to make your money on that milk. You've got to get something sold. You've got to get a transaction done because you're running out of time, right? Now, if you're a buyer of the milk, and you go to the grocery store, where are you going to look for your milk? Where are you going to look? And see, Corey, this is where I have an advantage. Sean says, I'm only 6'4", and he says, but I'm going to still reach back there and get that back carton of milk, which is exactly right. Now, I'm not much taller than Sean. I'm only 6'8", but I have what we call a plus. I think I'm a +4, meaning I'm 4 inches longer than I am, or wider than I am long, or whatever you want to say it. And I reach back there so far, Sean, that I go past the back, row of milk, and I reach back and I grab the cow udder, I grab the cow teat, and I just squeeze mine out. It's warm. I do have to refrigerate it and pasture, but I get the real stuff. So, but anyway, that's an example of dealing with theta, because theta can jack up what we're doing in terms of time. Not often, because the thing about theta, it's predictable, right? We know when milk will expire. That's not an unknown. We can put a label on that. We know the science, and we know when an option is going to expire. We know when LeBron James contract is up. There's not a lot of surprises here. Certainly when LeBron, negotiates his contract, or when we do a contract with real estate, we're going to identify that time up front, because we know it's a factor, but we want it to be one that's predictable. And it is the one that is predictable, completely predictable. There's no question of it. So this one's kind of a fun jester. He's not one that usually we get in trouble with too much, unless we don't know what we're doing and we just sign LeBron for half a season because we're stupid, right? You'd want to sign LeBron for as long as you could, right? You'd want to buy a player like that. If you get a 10-year contract on him, you'd want that. You'd want control of that player. You could trade him. You'd have control over that asset for 10 years if you could get it. An agent wouldn't do that, maybe, but or maybe they'd want that. Vega has a little bit of predictability to it. There's events in the market that can cause Vega to spike that we can't predict, but Oxy, I'll bet you anything, Corey, we could make a pretty good prediction on Oxy in terms of its earnings coming up. So we might look at a price slice on this here in a minute, and we might look at the idea that, the implied volatility might be rising going into the earnings, because earnings is an announcement that is unpredictable. It could be good or bad. And so we're going to brace ourselves for this. And we're going to say, gee, insurance on Oxy, the closer it gets to that date, is going to get more and more expensive, because there's more and more uncertainty in that stock price as we approach that date. And once we hit that date, generally we would see what's called a volatility crush, where we say, okay, now earnings is out. We kind of have more information on where this company might go. We got a pretty good idea of price now. There's not going to be another announcement scheduled on the calendar that we would be able to predict that might have an effect on Oxy's price. So that's Vega. So he's friendly too, but he's only got one eye here. He's got a bomb, where this guy's just playing with time here. He's actually has a bomb, like a poor earnings report that he could drop on us, right? So he's got the bomb. Delta, though, at the end of the day, when the option expires, there's no Vega left and there's no Theta left. You're left with the stock price. At the end of LeBron James's contract, you're left with the player. How good is he? How did he perform? What are his statistics now? All this other stuff is gone. And this is the one that will hurt you the most ultimately in these types of trades. It's going to be where the stock goes. This will go away after a while. This will go away after a while. This one is the big one that is scary. And so let's go back to Corey's screen, and we're going to talk to you a little bit about using price slices, which is a nice feature of Thinkorswim. It's not that it couldn't be deduced in other softwares. And Thinkorswim's going to change, by the way. Did you see that, Corey? They've got a whole new freaking layout, which is always good and bad when you have a new operating system come out, right? You got to find out where new stuff is. And
for sure.
For example, like I hate Microsoft Word now, and in trying to be new, they've tried to add so many freaking features that it's like a mess, and I just want to type a letter, So here we've got a couple of price slices, and you can drop down. There's a little.
These are currently at break even, right? You can see the little break even right at 0, but we could change this right down here and set the slices to a variety of different things.
Yeah. And we could add one, but with the plus sign, we could just hit that plus sign there and go, and now we've got 3. And you can see one of them is at the current price, the one he's moving around now. You just drag these around, and the other 2 at the break even. Now there's a little underneath the risk graph. You can see it says on the left hand side, it says price slices, and we can pop that down and see them. And what you're going to see here is you're going to see these Greeks. Now I didn't talk about gamma, and I'll just mention that gamma is just the rate of change of delta, which it basically is how steep the line changes, because it's not an exact straight line. It's if you're a physicist, you'll get off on this. If you're a non-physicist like me, it's a headache. But if you're an engineer type or physicist, there's a difference between velocity and acceleration. In other words, if I'm going 70 miles an hour on the highway and I'm just steady at 70 miles an hour, that's my velocity. But if I hit the accelerator, I'm going to have a change in my velocity, which is called acceleration. Well, gamma, delta is going to tell me how this is going to change with a move in the stock price. And all gamma is it tells me the steepness of delta. So we'll not worry about gamma too much. There is something called gamma risk. When you get elaborate in it, you can talk about the gamma smile. You know about that, Corey, and there's a lot of different stuff we can do. But right here we have those 3 monsters of delta, theta, and Vega, and we can, instead of just having little monsters, now we have actual numbers that we can see. So right now the stock price is at 58.38. So you can see of those 3 price slices, all the price slice does is tell me what those Greeks look like at that point on the price graph. So for example, we have a delta of 71.33 on this trade right now, because that's where it is. If this stock were to move to say down to say $53.61, that delta would be much increased. We'd have a big, our delta monster would be much bigger and much scarier, much bigger and much scarier. You can see that big number. And you can see that at 71.40 on the other string, we have a big delta number there as well. It's just on the negative side. So that's kind of interesting stuff. And these delta numbers assume positive moves in the stock. In other words, 53.61 is a big delta number, and if the stock goes up from there, we're very, very happy with a 140. But if it goes down from there, it sucks because it's a bigger number. Here in the middle, it's 72.19. What that really tells us is pretty simple. If this stock goes from 58.38 to 59.38, we're going to make $72 on this trade. And you can kind of see that in the purple line. If we were to, take our cursor over that purple line and just say, okay, it's going to go up. You see it's right now we're up $169. Okay, go up $1 and it's going to be about $70. You don't even need to move the price slice, right? Yeah, you go up $1. Well, adds about $70 to the total. If you go down $1, it takes about $70 off the total. So this delta just gives us a sensitivity to tell us how much we make or lose in a $1 move. Well, you can see down at the price slice of 53.61, our delta would be much more severe because the line is steeper. The line is steeper. If we're to drag that price slice to say 62, let's do that. To 62 where it's flat, you can see our delta there. I mean, we could actually get it to where it's actually at the flat point by looking at the delta. We could just see, inching it over and inching it over. Right now we're at a 5 delta. And if we 4, 3, how good is Corey to get that to 0? Can he do it? And almost, I mean, that's pretty good. Okay, there you go, right there. That's almost 0. So you can see that it's flat, that the purple line is flat. If we were in the ideal place right now, that would be the place for this stock to be. If we could magically wish this stock to go to any price, we would love to see it at 62.38, because right there's just almost no change in our trade going up or down. It's dead center, and what we would do is wait for the time to decay. We just wait for that little theta monster. And you could also see that at that point, look at the theta column at 62.38. We're making $17 a day in time decay right there. That would be the beautiful place. This is a time decay trade. It's a range trade. We don't want the stock to go outside of the range on the top or the bottom. So if it stays in the middle, our time decay is the greatest. Absolutely fantastic stuff. Of course, the Vega here, if we had an increase of volatility, we'd have to be more patient. If we wanted to get out of the trade, it'd cost us more by $18 if we had an increase in Vega. So what the price slices do is they basically help us see how to juggle those 3 factors of price movement, time decay, and volatility. And that's what the price slices generally do, is they just help us with those Greeks. Of course, you can also see the profit and loss, with each price slice. If we were at 62.38 and we wanted to get out of this trade today, we could do it and make $314.27. If the price was to fall down to 53.61 and we wanted to get out of the trade today, it cost us $300 and 43 cents. As of today, it's at 58.37. If we wanted to leave the trade today, we could do it with $161 profit. So you're going to notice something here. There's 4 red hash marks on the risk graph, 4 of them. The first 2 hash marks are where we would break even on the timeline, the time decay line, the purple line. And that's where the purple line just represents the value of the trade today, how much we would make or lose if we exit today and want to buy back the options we sold and sell back the options we bought. But you can see as time marches on, it's going to conform eventually to that blue line, and there will be no time left. So theta won't be a factor, and there'll be no volatility to have happen because there'll be no time left for it to happen. And it'll basically be about the delta. So where, yeah, you can see as Corey marches time along, that just conforms, and you know, we would be at almost max profit before expiration if it stayed where it was, right? Right there. So these price slices simply help us plan and predict a little bit about what we might have to do and where things might be. There are two parts of this trade, and of course we cover this in greater detail in the Ultimate Options course. This is a quick start lab, so we're starting a little quick. We're getting people going, you know, a little quick. We're introducing this quickly in a quick start lab, but you will find some interesting parts of this. If you look at about 5250, you'll see a real interesting part of this graph where there's an intersection between this timeline, you know, the purple line and the blue line, and there's also one on the top where there's an intersection, and that's called the theta switch. If you watch when Corey marches time forward, you'll notice that let's just go to look at the one at 5250. You'll see that everything on the side of that theta switch on one side is benefiting us with the time decay. We're benefiting from expiration, but everything on the other side of that is to our detriment as it conforms that line. So learning about the theta switch is a very important thing, because I know as long as I'm on the correct side of the theta switch, every day I'm getting paid. The trade's helping me, it's getting better. But every day I'm on the wrong side of the theta switch, that sucks. So I never really want to be on the wrong side of a theta switch here, ever. The other dilemma we have with this is this is what I call the Bermuda Triangle of iron condors, and maybe you could draw it in like a yellow pen, Corey, and I'll show you how you draw this, because this is the Bermuda Triangle of these trades. You start on the red hash mark about 5650, right up there on the zero line, and you draw a straight line between that hash mark where we start losing money in the trade today, and then the hash mark ultimately at 5350. So it's a straight line right there. Okay, then I kind of go down to the theta switch right down there. Yep, kind of not even, and then I do the hypotenuse right there. And this area sucks, particularly the part of that triangle that's above 5350. This area really, really sucks. This area is where the Ultimate Options class is worth your money to take, because the problem we have, you know, right now, if we look at our price slice, our theta right now is 1570. We're making $15.70 a day on this. You know, it's glorious, it's beautiful, we love it, it's fantastic. And as far as our profit and loss goes, we're up $165. We could leave this today with a profit and be very, very happy. So, you know, if we felt like Oxy was going to be threatened, if we felt there was an event in the market and we thought, you know what, I think we've been in this trade, you know, a couple weeks. What's our ROI if we leave today, Corey? I mean, we're probably 10%.
Well, yeah, so we have $165 of profit. Let's calculate it together. So we have $165 of profit if we want to leave. This trade, we did 5 spreads times $5 each. So that's 2,500 is the size of the trade, right? Because we had $5 spreads times 5 contracts, but we collected credit of 140 times 5. and maybe I'll pull up the calculator so you can see all
Yeah.
these numbers together. So let me
Yeah.
go back through the math a little more slowly. If we say we traded $5 spreads, we're controlling 100 shares of stock. So each spread is a $500 capital times, we did 5 of them. So that's where the 2,500 came from. We brought in a total of $140 credit per iron condor. We did it 5 times, so that's 700 in income. So basically our capital required in this was $1,800. So if we exited today, we'd basically make $165 on 1,800.
And incidentally,
9.16%, about 9.2%
and
return.
that's have we been doing this 2 weeks?
Yeah, so we really started it on, what is it, February 6th? So yeah, I mean, basically 2 weeks exactly, right
Okay, so
around there.
that means we get to times that number by 26. Isn't that right? That would be
Annualized.
Yeah,
Yeah.
so we times that number by 26. So what is that? Okay, so that's 238% on our money annualized. That's 238% annualized. And we say, you know what, we're happy with that. We could just leave that be right now, and let's go do another one for another 2 weeks. We're in a position of power. Now we're not going to do that because time is on our side. We barely had that thing decay. See how much room that thing has to go up as time decays. I mean, let's just see what it is in another week. Let's just march that forward, and in another week, we'd be at 272. So time is on our side. You know, we're in a very strong position. Okay, now here's your problem. What if this stock were at $54 right now? Let's put our price slice let's go to today. Let's slide our price slice to $54 and get in that nasty place. Okay, now we'd be down $300 in the trade. Okay, that would be awful because now if we want to leave it, we'd lose $300. And we're very, very close to where, you know, the delta would kill us here. I mean, you know, if this price falls, you know, to 52, 50, 51, 49, we're going to get our butts kicked. So we're much more alarmed when we're inside that little triangle because the damnable misery of it, and this is where people get killed emotionally in this trade, is they're like, I just hope it'll go back up. I just hope it'll go back up. I don't want to lose $291.71 by exiting this trade. I don't want to lose that, you know. So I'm just going to hope it goes back up. You've lost control of you're not in a position of power right now. You've lost control of your trade. I mean, we never really control the price, but we're certainly not in a position of power. Rather than being up $165 and having time decay on our side, we still have it on our side in terms of time decay, but if we fall below that 53.61, we're going to start losing money. And, you know, boy, if you get way below that, you know, if you get below 50, you're going to lose $1,800 trying to make, you know, 700. So, so that's an alarming place to be. And you need to start thinking about, you know, taking some action if you're in that Bermuda Triangle deeply, you know, you're in a place deep into that triangle on either side, there's got to be, you just can't have hope as a strategy at that point. You've got to do things. You've got to make adjustments. You've got to minimize a loss, or this is a losing strategy. It just is. And you've got to do it on that side of the theta switch, and you've got to do it soon. So hopefully.
And Andy, you can even see that today was kind of a rough day. If we look at where the stock price is today, but our profit and loss for the day, so we were up, you know, 250, 260, whatever yesterday, but what's happened today? Well, the stock was here and then it tumbled a bit today. So now all of a sudden you can see the kind of the progression of this thing. And if that keeps going, if that stock keeps tumbling this way, that becomes a big problem. And then the other thing with Oxy is we know there's an earnings date coming up. And so that adds another little, you know, twist to this trade where we don't have to stay in and through earnings. We could be in this trade and take our profits before earnings ever hit and so forth. But be aware of your earnings dates. That's coming up. I think it's next Monday or something like that. Now, earnings could be very good or bad for this trade, but that certainly adds an element of delta because stocks oftentimes will move a little bit more on their earnings, don't they? That's a little bit of a jolt of energy where that stock price can move, and it can move up or down. It could move sideways, but a lot of times there's just this little added jolt of adrenaline pumped into the stock where it'll have a little gap one way or another, and that can make things a little bit more difficult. And as you enter, remember this red mark here is really where you start to enter the loss zone. And so if you're considering kind of hedging and whatnot, I mean, hedging as maybe just before or as you're entering into that zone, even if it's not a big hedge, this would certainly be an area where I would start to consider some sort of hedging and whatnot. We teach that in the Ultimate Options, how you could delta hedge and do a variety of different things. You could roll, you could do a lot of stuff where you open up your toolbox, and there's a lot of repair strategies and things that you can do with these. But that would become an important
It
point.
may become an
to
important
consider.
one in this that we'll talk about. But for Sean, back to Sean, Blinky, that's so awesome.
That is funny.
Sean says if you drink your milk and it's sour and you have to blink your eyes a bunch of time, that means the milk's gone blinky. We don't want blinky milk. We don't want any solids in the milk. Okay, none of it. But does that help, guys? Was that helpful? A little thing on price slices. Now, let's get rid. You can go down to that 52.23 price slice or 58.23 price slice down in the, I think it's the third on the bottom, and you can right click on that. And what you can do is you can say delete. You can just get rid of it. Okay. So watch this now. Now you can go to the far right where those little bars are next to the plus sign. And there's this thing that says set slices to charts. Now watch this. And then we can go over and we can just pick one, just boom, right there, click. Now we can set, oh, why didn't it set it? I don't see them. We should be able to set slices to the charts. There we are. Okay, now we can see these red lines. See the red lines? So the red lines now represent our break-even point. And now we can see this vertically instead of horizontally. Now our prices are going up the right-hand side vertically, and we can see it in terms of a stock chart of where our range is that this thing has to stay in. And here's some good news for us. Could be good or bad. The low, the recent low is 57.43. Well, we're a little less than $1 above that. We can also see that the last time it got in that area, we had a huge bullish candle for whatever reason. So we have a couple of, there's a big one. We have a little bit of support right here. And this is good and bad. If this breaks the support, we could be in for a little bit of a fall. So right now, here's an interesting thing that Ron LaFawn said. He said, well, I've heard of people just pulling, they're up 50%. They just pull out the table and be happy with, half the profits. I wouldn't do that because I'm going to see if that resistance or that support holds. I wouldn't get out of this trade right now. That support might hold. And I have a technical, I kind of have a blocker out in front of me. I'm the quarterback sitting back there, and that low 57.43 blocker is still holding me in the pocket. He hasn't collapsed the pocket yet. I don't need to scramble yet. I can stay in the pocket. I got a blocker out there in front of me. Now, if that fails, I might have to flush from the pocket and throw this thing out of bounds at that point and, go play another down another day or punt. I might have to throw that thing out of bounds and punt and get some better field position, just leave this trade and say, hey, I'll live to fight another day instead of trying to throw an interception here. I'll throw the ball out of bounds and, let's be smart about this. So those are the price slices. So let's go with let's go back to Sean Stone. Looks like that was helpful. So better understanding. You didn't slow us down at all, dude. That was I mean, we need to talk about the Bermuda Triangle anyway. So what we need to do, and I'm just hoping we have this thing fall. One more thing we ought to bring up is let's look at a chart of Oxy. Let's look at a chart. And we probably just can get rid of the two of them, just go to the one. And the way you do that, I'm always, Corey uses Interactive Brokers. So, I use Thinkorswim more. So that's why I'm pointing out where all this stuff is. If you go to the beaker, which is, there's share, there's a cogwheel, there's style, there's drawings. You go to the beaker. Oh, just left a couple more. Corey. One more. There you go, beaker. Those are your studies. And if you type in the top box, just, VOL for volatility, it'll run things for all the volatility. In fact, I like to say implied volatility. Let's go IMP. Okay, see that implied volatility right there? Let's add selected and let's apply it and hit OK. And that should give us an implied, and I don't know if that's adjustable. There we go. Okay, now here's an interesting thing that we'll see. I don't know when the earnings date is. Are we on it?
I think it's March 1st, what I remember.
So I believe you can see that this is starting to climb. See this? It's starting to climb. And as we get into an earnings situation, this is going to continue to climb. Now, there are other factors in implied volatility. Here's an interesting one that's usually pretty predictable. Go to Facebook. And Facebook might be jacked up. I haven't looked at this in probably a couple of years, but a couple of years ago, watch this right here. It's pretty predictable. Go back to September and you see it climb and you see it climb and you see it climb. And then right there, it hits a peak at what? Oh, I'll be darned. And right after that, what does the volatility do? That's called a crush. Okay, then it hits a bottom in December and it starts to what? It starts to climb. It starts to climb. Then it hits a peak, right? Oh, right there. And then what happens? It has a crush. So I haven't done this trade in a while.
And that represents earnings.
That's earnings
announcements.
So Facebook has a personality of this, and if we brought in more time, we don't need to. But you see that pattern? So think about this, guys. Talk about opportunity, and most people with a 401k would never even realize this, that is a semi-predictable event. Semi-predictable. Price is hard as hell to predict. Time, easy to predict. Time just, here's our time prediction. Wednesday will turn into Thursday. How about that for brilliance? February will turn into March. I can't even go long term. 2023 will turn into 2024. I'm correct on all of those predictions. So time decay is my favorite way to make money. It's the most predictable. The next, kind of in the middle of that is volatility. You can see here that there's a pretty predictable thing in that it would make sense that option pricing would get more expensive going into the earnings, because an earnings announcement, well, look at what happened to the stock price on those earnings announcements with Facebook. It has a gapping personality. So Meta on the first earnings announcement, fell what? $40, $30 on one earnings announcement. And on the next earnings announcement, it gapped up probably $30. So, because of those gaps, because it has a gapping personality, obviously options, if you own Meta, you'll be more likely to buy an option for ill or for good proximate to earnings to protect yourself. So no wonder the prices of these options are going to increase as they get into that stuff, and then decrease the very next day because earnings is out. Does that make sense? Give me a little feedback and see if I made that clear at all. Does everybody kind of catch that stuff? Does everyone see the logic of the big picture, that that, yeah, man, the volatility should be increasing going into earnings date and then just crush. So, if you wanted to, you could go and do like a really wide short strangle, and you could get paid. Like, let's say you did a short strangle that was really wide, the week before earnings when those premiums were juicy. And then all of a sudden there's a volatility crush, and now those premiums are not juicy. You could sell that short strangle when it was juicy, buy it back when it's not, and you could actually make money on simply the volatility change in that short strangle or even a wide long-term iron condor. Your challenge would be delta. How far will it gap? And if it doesn't gap very much, and as long as you look at its gapping personality and you look at support and resistance and you get that thing wide enough, yeah, it's going to gap, but it's not going to gap $100. It might gap 30. And so you can actually make money on the prediction of the anticipation of a volatility crush. Now, this is a little more risky because maybe there's an event that we don't see that has to do with earnings, that 9/11 type stuff, right? Oh my gosh, then those options get even more expensive and we can be underwater in that trade pretty quickly. So position sizing would be important there. But you can see how, juggling theta, juggling vega, juggling the delta, the movement of the price, they all play a part. You can see very clearly how someone who doesn't understand vega or theta could buy some type of an option, and the price doesn't necessarily move in a way they'd lose money, but perhaps the volatility would. And so they get in their account, they're like, well, what the hell? How come I'm down so far in this option and the price didn't even move? Well, maybe maybe you have an earnings date you didn't see, or maybe there's a volatility event and it's jacking up your premium and you don't know it, because people trade options all the time without understanding this stuff. They really do, all the time. You're pretty okay in writing covered calls without understanding this. It never hurts to understand more. People in the United States can write covered calls in their IRA, and I'm less worried. Like a cash covered put, I really don't care about that because you want to buy the stock anyway. Who the hell cares what the Greeks are? But once you get into these types of more advanced trades like we're in now, essential. I mean, just the education is essential. So is that helpful a little bit, understanding this type of stuff? And so I'm glad so many of you said, hey, I'm going to take the Ultimate Options class. Well, this is a nice advertisement for that, and kind of an introduction to why it's tens of thousands of dollars, to someone that understands this as opposed to someone that doesn't. Easy, in my opinion. Anyway, let's go back to that iron condor graph.
Yeah, and Oxy I had the right day, but not right date. I guess it is Monday, but it's February 27th. I had the wrong date. I think I said March 1st or whatever, but next Monday.
So what's going to be interesting is watch this. Let's shrink your risk graph a little bit so we can see what's down below. Yeah, and there's a little cogwheel in the bottom right, and you open that cogwheel up and you can see volatility adjustment. So this would be interesting if we have a volatility crush in this trade while we have it on. In other words, if the volatility drops in 5 days, you can see we're going to make money. As he, like, let's just put in, before you enter, put in like a 5% drop in implied volatility and hit enter.
Yeah, and watch the purple line as I hit enter right here. You'll see it jump up in profitability.
Ready, and 1, 2, 3, jump. Now take it back to where it is today, and you'll see it jump down. See, jump down. So if we had a 10% drop in implied volatility, minus 10, jump, boom, up it goes. We make more money. So right now, a volatility crush over earnings would help us in terms of volatility. Our volatility monster is friendly. However, what could happen? Let's see how smart you guys. What could happen over earnings that would suck for us? Yeah, the volatility crush would be great, but what could happen? I mean, time's not going to be any different. That one's consistent. But what could happen to Oxy over earnings that would possibly give us a headache? Paul Kim says a big price move. Yeah, if that price drops down to say 54 or breaks through the resistance or the support that we saw on the chart, we're gonna have to make an adjustment. The good news is even if it dropped to 51, we wouldn't even be halfway to our max loss. We could still do some things. In fact, even if it dropped to 49, we wouldn't be at our max loss. We'd be hurting, no question, we'd be hurting. But here's what I'm going to tell you, and I think Corey will concur. You never want to take a max loss on one of these, and people do it all the time. They do it all the freaking time because they start usually by getting that in that Bermuda Triangle or worse, and they don't want to get out of it at that big of a loss emotionally. And so they sit there and they all of a sudden hope becomes their strategy instead of risk management. Hope becomes their strategy, and they hope something happens to have it pop back up, and they have completely no control over the trade. They're not doing anything to help themselves. They're just sitting with their finger in their ear instead of on their mouse. And you don't want to be in that situation. So that's a pretty lengthy view.
Well, that's why with earnings coming up, I mean, it would be tempting to maybe take profits in that earnings can create a gap, and gaps are the single biggest risk to this, because instead of moving and kind of going this way where we could start putting on hedges and things like that, you're left out in the cold to a certain extent if it just gaps here. If it just gaps from this price at 58 to this price in 52, that sucks bad, and you had no real opportunity. And earnings increase the possibility that, let's say, the probability of a gap. We wouldn't anticipate that it's going to happen, right? We could actually look at the history and we could do some analysis, but it definitely increases that possibility. So we specifically put this on past earnings, so it would give some idea of what can happen and how this behaves, and it'll give you one example. It's not a huge sample size, of course. It's not statistically significant, this one scenario, but it will give you some experience of saying, okay, let's go ahead and trade this through earnings and let's see. And it could be a big blow up, right? We could see the stock gap. It could gap this way and be perfectly in our favor. We don't really know. We don't have any certainties as to how the market is going to behave after those earnings come out. And so you're in control as the trader of this. You have basically a few different options at your disposal. You could take profits. You could reduce position sizes. So we could say, well, you know what? I've got 5 of these on. Do I have to take the same amount of risk into this? Well, maybe not. And so I could come over here and I could say, you know what? I'm going to create a closing order for this. And instead of removing all 5, maybe I go ahead and buy back 2. Or maybe I buy back 3 of them and I get smaller in size. And so I put some of the profit in my pocket, and then I take some of the risk into earnings. And so these are the things that you should be thinking about as a trader, is just how first rule is, how do I protect myself? How do I avoid max loss at all costs? I'm not going to take max loss. I'm not going to have a big blow up. That's my first rule. Second is try to maximize profitability, of course, but with that first rule as the trump card. We don't hold and hope, because it brings max risk into play. We take an action so that we reduce the potential for max risk, and we create, even if it means that we don't make as much as we could have. The trade works out, and we got stopped out and lost a little bit on the hedge. We didn't make what we could have. Maybe we took a small loss, even though the trade would have been successful. those are all good outcomes. Those are all, you're doing the right thing by
Better than
avoiding those max losses.
Better than max loss. Let me address, we had a barrage of questions on this. I'm going to address them one at a time. I think it's worth the time to do it. Let's go back to that Facebook, if you would, with the volatility there, and let's put in some time. Here we have two gapping ones. Let's put in enough time that we can find one that maybe didn't gap. So if we go up to the cogwheel, or the day, I guess the day is what it would be right there. Time frame, yeah, 3 years, weekly for 3 years. That might do it. No, that's not going, we got to keep it daily so we can see the gaps. So let's go daily, and then let's go back to that D. Corey doesn't use these. Go back to that same D where it's a, yeah, and then time frame right there. Click on time frame, and let's go an interval like 5 years, 4 years, whatever, and okay. I have to help Corey navigate this because he simply he uses a different platform mostly.
I've used Interactive Brokers for about 20 plus years, and I've used Thinkorswim for a long time, but I don't always know exactly what you're going
for. Sure. If I went in Interactive Brokers, Corey'd be saying, Andy, click here, click there. Okay, we don't have all the earnings listed here, unfortunately. We can see some big time gaps, but we can also see times where obviously there were earnings dates between these where we did not see gaps. See that? So the question Maddie had is, what conditions would have a volatility crush without a big price change? Pretty simple. The volatility crush doesn't happen because there's a price change. The volatility crush happens because there's less potential for a big price change. So for example, you could have a massive implied volatility buildup, and then all of a sudden the earnings comes out and it says, oh, we hit our earnings and we have guidance for pretty much the same. Well, then the price wouldn't change. So it's kind of like when you buy your insurance and your car doesn't crash or your house doesn't burn down. It just happened. If we mouse over some of those earnings,
this one was maybe a decent example. There. It has a little bit of a gap, but not anything too major happening there.
If you get rid of your pen and mouse over that earnings, it'll actually tell you what happened. If you put a regular cursor on it, it usually just has a bubble pop up, does it not? I wonder why it doesn't. Maybe your settings aren't to have the bubbles pop up, but generally you can have oh, there you go. So the estimate was $2.51 and the actual was $2.46. Okay, big deal. Now look at the one where it gapped down. Let's move that one. Okay, the estimate here was $1.88. Oh, only $1.64. And they might have given guidance that says, oh, and by the way, we're going to, we're just by way of announcement, we're also getting sued for, invading people's privacy, whatever. If we go to the most recent one where their earnings were, let's see what it was on February. Okay, here they had an earnings of 221, and the estimate in the actual was really low, but they might have had great guidance. So they missed earnings by a ton, but they might have said, yeah, we did miss earnings, but our guidance for the future is bright and awesome and killer. And so those earnings calls have both the data and the forecast, and it has a lot to do with the forecast. But you can see how you can, this is a beautiful example of all three. The first one, the price didn't move. The second one, it gapped down. The third one, it gapped up. But to Maddie's question, the actual gapping isn't what changes the volatility. It's simply the removal of uncertainty. Once the earnings is out, it doesn't really matter whether the earnings were good or bad. The cat's out of the bag. There's no reason to freak out because now we have information, right? We have information. So moving forward the next day, well, you're gonna have a crush in volatility, implied volatility, because we know the data now, and we need some time to go on to kind of build the suspense for the next round of data, if that makes sense. So,
and this is a really good example here of how the markets can be kind of confusing, because the earnings were expected to be 212 and they came in at 176. So that's a big miss, yet the stock was up sharply.
Yeah.
And so remember, I talked about the Chinese parable, right, of the Chinese farmer. And I don't know if it's good news or bad news, it's just news. Well, that's kind of what we're talking about here. Is on the surface, that seems like bad news. But if you dig below the surface, what's happening with Facebook, they changed their name to Meta. They've spent billions and billions of dollars investing in the new virtual reality, all of that stuff. And the markets got really concerned about how aggressively they were spending all of their capital and earnings and so forth. So here they showed no signs of reducing spending and kind of scaling back those investments, and the markets panicked on that. And here they basically flipped a 180 to a certain extent and said, hey, we're going to be less aggressive with our investing in this space. We're going to retain more earnings. We're going to play it a little safer. And the markets cheer that on. So it's a narrative. It's just news. It's not good news. It's not bad. It's news. And then we figure out kind of, okay, well, what's the price action? What was the market's thought? Was it priced in already? You know, it's kind of the buy the rumor, sell the news. What is the market most worried about? Did they beat on that metric, and so on? And so that's where the markets can be a little bit tricky, is you can't just say, well, did it beat on earnings? Well, it should always go up. That's just, that's not exactly how the markets work, right? It's just news. It's you know, I think that Chinese parable is just a great example, because the CNBCs and the Bloombergs and so on will always spin it a certain way, and that tends to get people on the wrong side of those trades oftentimes, because they just react to this quote unquote good news or bad news situation. So
I'd encourage everyone to stick with and stay up on Mentor Club, because we run into these sometimes. I'd encourage everyone to keep pursuing learning. I thought that Mark had a good question. You know, hey, learning how to juggle the delta, the theta, and the delta. If you go back to a risk graph, you can really get a good sense, if you practice, how a change in one would affect the overall position we're in with Oxy. Obviously, if you just look at the purple line, you can obviously see that a gap down hurts us from where we are, right? We're at 58.5 right now. Obviously, it's pretty easy to see that a downward in price hurts us, right? But a volatility crush would help us. Why? Well, because if we take uncertainty away, the options that we sold could be bought back cheaper. In other words, if there's less volatility than when we started this thing, we can buy those options back cheaper. So the volatility crush actually brings our line higher. We love the volatility crush. So if we could come out with Oxy earnings that are like a snoozer, like, oh, no big deal, that would be awesome, because then our price would stay the same, but the volatility is going to crush no matter what. No matter what, once those earnings come out, they'll say, oh, okay, well, there's no uncertainty in this now, or at least reduced uncertainty. Options are going to be cheaper. And since this is a net credit trade, we get out of this trade by buying back things more so net than we are selling things. So we're buying back options that we've sold, we're selling options that we bought, but the options that we sold are much richer and closer to the money in this trade. So that gets a little complex, but that's the price you pay for a return that we're going to get here of $700 on 20, less than what, $1,700 worth of risk probably. What are we taking in risk? Let's move our mouse down and see what the risk is on that exactly.
1,800.
$1,800. So our max profit on this that we could go for, if we put our mouse in the middle, is $700, and our max loss, I mean, to get that type of return, to invest $1,800 and make $700 in a month is a huge reward. It comes with risks, but the education's worth it, if you want to trade this way. it's worth it. So does that help, Mark? You'll want to just keep practicing with these where you get a really good sense of, okay, time decay is always going to help me in a credit trade. Always. It's just always going to help me. I'm selling an option. It's like being the landlord, right? I'm always in the better position as the landlord than the tenant, always. Time always helps me. It always is against the tenant. It's just how it is. So positioning yourself that way in life, as a producer, a seller of things, it's always better to be a seller of things than a buyer of things, right? For sure in real estate and in options. If you look at implied volatility, it's about how much the options are going to cost. Lots of volatility, they're expensive. Less volatility, they're cheap. And then of course the delta. We're going a little ahead of ourselves. I'm kind of hoping that this was going to be maybe 2 quick start labs down the road, because what we're really hoping is I'm hoping Oxy goes down in the Bermuda Triangle, where we don't just talk about it theoretically, we get to talk about it realistically. And right now we've got a real good chance of that. I mean, if we move that price slice over to the edge of the Bermuda Triangle where we start losing money today, we've got a 40% chance of getting there, right? Of being in that spot. And if we go probability of touching, we're going to be really, 79% or whatever. I mean, there's a real chance we could touch this. So that's, we got a real good chance to have to teach this. Let me share my screen again, Corey. Some of you that have taken Ultimate Options are going to recognize what I'm going to show you. And just to set up when this Bermuda Triangle happens, some things that'll help you understand what we're going to do. To give you guys some solace, like, why are we not worried about this? Why are we not freaking out that it could get there? Are you guys okay if we take another little tangent? Let's see, how am I doing this? I can't see where I'm making myself the presenter because I got too many dang windows open now. This is a tragedy here. I think Corey made me the presenter, and I don't know how to, there we go, pop up. I got pop-up windows that I can't find here. Here we go, show my screen, there it is. Okay, so the first thing is what happens when this monster grows from this big to this big? Can everyone see my screen? Corey, can you see my screen? Am I talking to myself?
Yeah,
I think you
perfect.
might be.
Yep.
Hey, Cleve Burbish says a tangent is okay. All right, awesome. So what happens?
Tangents better be okay, because you get a lot of them. So
we got a lot of tangents here.
you get together with Andy and I, we love tangents.
We get talking too much. So, the delta is the biggest, meanest monster of them all. And when you have a gap down, like we just talked about, and you get that Bermuda Triangle, you have a delta problem. In other words, the change in the amount of money you're gaining and losing with every move now, that purple line on the risk graph has become much steeper. You can remember that when we had that in the middle, so let me kind of show you. We had an iron condor graph that looked like this, right? And here was our break-even line. And we had a purple line that looks something like this. And then went really, really flat right here and went down. And this area where it's not very steep, this area where the line is flatter is like a zero delta. It just doesn't really matter that much. But if I get in the Bermuda monitor, you see how steep it is right here? So the steeper this gets, the bigger he is, right? The more of a change it is with every move. Here, a $1 move in the stock is meaningless. Here, a move down is devastating, right? And so once it gets in that Bermuda Triangle of risk graph, this dude is like, 100 feet tall and he can gobble you up in one bite. And it's awful. So I'm going to give you a couple ideas here. First of all, we did 5 contracts, right, Corey? Okay, well, if you'd have done 1 contract, he's 1/5 the size already. So by simply doing these in a way, by simply doing these, Ron says, Andy, tangents are good, are the best, okay. By simply saying, hey, you work for me, pal. I'm not going to let you get big. Always remain big in your money. That's the only, I don't have any quotes on like AZ quote or WikiQuote or any of those websites. I'm not popular enough to be quotable. But if I ever had one quote financially attributed to my name, this might be among the handful I'd like to have. Always be big in your money. You face those, I teach this to my sons. Greed is, if you feel greed and you act on greed, then your money got bigger than you. It controlled you. And so you always get principles, and you stay to those principles, and you always remain bigger than the money. And part of doing that is position size.
Yeah, and a lot of people, that's where they make their mistake. Envy is a crazy emotion where if you see other people making money, and it doesn't matter the market, right? It was in the 2000s, it was the tech bubble. In the mid 2000s, it was the real estate market. And recently it's been crypto. When you basically are forcing yourself into markets or into trades or position sizes that are too big because you want to make an X amount of money, or because you want to keep up with these other people or whatever. I mean, it's just a huge recipe for disaster, and it drives markets. So if you can spot that and you can say, hey, the crowd behavior is rushing into this market and it's getting kind of out of control, that can be informative of where a bubble is brewing and where it's unsustainable and whatnot. And so we want to be, I mean, I love that saying, bigger than your money.
You be bigger. Let's say this happens all the time to new traders. Someone has a car payment that's $700. And so they say, I would like to have a reward of $700. I want to make $700. So what am I going to do? Well, I'm going to do 5 contracts so I can make $700 and I don't have to work to pay my car payment anymore. I can just trade my way to make my car payment. That's called position sizing to reward, instead of position sizing to what? To risk. A better way to think about this is to say, hey, you know what? I'm not ready. This is too big. This is too much of my portfolio to risk. If I lose that, that's too much. So maybe what I do is I do one contract, which would have been what, $500 minus whatever it would be. Corey, what was our premium we brought in? Oh, you went
brought
mute.
in seven. Whoops, I was muted. 700 in premium coming in and 1800 of risk.
Okay, so if I did one contract though, that'd be
so 140, 140. Yep.
So we bring in $140, so that'd be 360.
360 at risk. Yep.
So now I take my risk from 1800 down to 360 max loss. Well, I can handle a $360 risk. And what I'll do is I'll take that $140 if I make the reward, and now I make myself bigger, right? If I get the 140, I make myself taller and bigger. And then next time, I can start to compound, and maybe someday I'll get here, but not today. Maybe someday I'll get here, not today. I'll compound. I'm still making the same percent. I'm just not putting all my money in this one place. So that's one way to really think about doing this, okay?
Yeah, and Andy, we could even do that. I mean, that's kind of what I was referring to, is we could take the position size down now, and that might not be the worst lesson of just, hey, let's reduce position size, and that makes a better situation through earnings and things like that from an educational standpoint. And then if the trade gets in trouble, you're in even less risk than you originally started with. You can hedge, and your hedge would be smaller position sizes and so on. So there's a lot of benefits, of course, to smaller position sizing in terms of the risk, no doubt about it.
Now I'm going to date myself. When I was a kid, there was a movie about a bully. There was a movie about a bully called My Bodyguard. Just curious, does anyone happen to seen the movie My Bodyguard? It's a movie it's a coming of age story. It's this kid in like junior high or high school. He's kind of wimpy, and he's getting the crap kicked out of him, right? And Sean's seen it, Timothy's seen it, Lynette seen it. And so this kid is having to deal with bullies, okay? And he's like, all right, these guys are taking my lunch money every day. Instead of giving you guys my lunch money, it'll cost me less to hire some dude to fight my battle for me, right? Now, I want you to look at the expression on this monster's face. Everyone see how confident he looks? See how mean and tough he thinks he is? Now watch his expression on the face when I get my bodyguard. He's like, oh, okay, well, now I got my buddy over here. So another thing I could do, and we're going to work on this next week, is I could go out and let's say that I have a delta line that now is steep like this, okay, and it's looking like this. Well, if I go and I get another trade, right, that has a delta line that is exactly the opposite of that, right? In other words, this line plus this line, what does it equal? It equals that line. Because if I superimpose these on each other, right, like this, and here's my position, well, great. If I lose a dollar here, I gain a dollar here. And if I gain a dollar here, I'd lose a dollar here. So my net, if I go up higher and I gain $2 here, I would lose $2 here. If I go up even higher and I gain $2 here, I'd lose $2 here. So no matter what I do, net, I'm at zero in this line. I'm always at zero. It's a total antacid. It's total neutralizes it. And so what if I do this? What if I have both these concepts in my mind where number one, I keep him small, and number two, I know how to hire bodyguard. If I combine those two, now I get that. Oh yeah, I'm gonna get you. Oh no, I'm gonna get you. And I relax. Okay, and I relax because now I'm both small and neutralized. I can live with these things right here. Okay. Oh my gosh, you're killing me, Sean. That I'm never gonna repeat that one. That's hilarious. So he's killing me. So that is, we'll talk a little bit about how to understand what this delta line is. The thing that's cool, we can't do this whole class, it's too big, but I can find, this has a delta right here of 360, this has a delta of 290. I have all my probabilities here. And what we do is in this class, we say, look, if you simply do this and you have a 900, if you just trade 10 times, it's the same trade every time. You have $930 risk and a 90-10 probability. You're losing net. You might make all this money, but the big max risk takes out all your profits and you're behind. Okay. If we can reduce the risk and take some off the table once in a while, well, now we're treading water, right? We take you through the different scenarios of, with probabilities here of 80-20, where you have two of them, interesting types of things we can do. Now, here's the deal. We can get to, I don't know where I can find this. There's too many graphs to go through. But we're going to show you how to delta hedge this stuff. It takes a little longer, but hopefully we can get to where we say, aha, with the right delta hedging, we can take this same trade and we can reduce these max losses to where now, we have a nice trading strategy that goes from an ass kicker with just simple numbers to something that works. And that's all about your ability to adjust. Now, I had another question, and I'm going to hand it back to Corey. And we might just have to call it good and do our directional trade next week because we've gone too long. But I don't care if we go on tangents. That's what a live class is for, right?
For sure.
The recorded classes always stay on track. But this is a huge question. Someone asked this, I think it was Lynette. She said, do you go over adjustments in the ultimate options, or is that covered in Noah's playbook? Okay, that's a really good question. Let me go bring these back up maybe. What we do in the ultimate options is we do what's called risk management adjustments, okay? So in the ultimate options, we say, okay, here we start with a trade like this trade here. This is about delta hedging. This class is about delta hedging, and we're going to talk about what a hedge is and the history of the hedge and the rhino tanks that bust through the hedge and all this type of stuff. And we say, look, this is our price mover shield, right? If the price moves, this is our delta hedging concept. So we're going to go through, for example, this one, we're going to use an iron condor as a trade that doesn't work out if you do it long term and takes max losses. People get all excited thinking, oh, I'm going to make 65% every 6 weeks and compound my way to heaven. But if they think that's going to happen, they're smoking that Colorado grade marijuana. And they have marijuana now in my state. In 2018, only Colorado had it. Now we have it in my state. But sorry, iron condors over the long term, they feel really good every time they win, but that one loss kicks your butt. So we're going to go through all the adjustments of how to adjust it out of a loss and reduce your risk and turn it into a gain. But what the playbook does is a lot more enhanced, Lynette. What the playbook does is it is a playbook of much richer sequence that transforms one trade into another trade, that transforms one into another, into another, into another. And it's much more about repair than just damage. And the playbook is not for the faint of heart. It's really a long, robust class. The thing that makes you decide this, by the way, how much how much is enough? Well, for me, I just like it, so it's never enough. But if I have a compounding calculator and I have lots of time, my kid's got 40 years, they can get an 8% return and make $5 million easy, with a pretty standard S&P type return. But if I have 10 years left, that same 8%, even if I have 10 times the cash I'm starting with, right? If these guys have 1 times the cash, these guys, they're going to wind up with 300K. So that 10 years, right, as opposed to 45 years really hurts them. So a person really can't do anything about that. They really can't do anything about that. They can only move this needle. And so that really says I either curtail my goal and say, well, I'm going to retire at 75 and put another 10 years on that instead of 65. And then I'm going to, get some education to increase this. But the problem is, as I increase this, my risk increases. So the ability to manage this. That's why these things are dangerous to uneducated people right there. Is someone comes in here, this happens all the freaking time, man. It happens all the time. Someone says, oh, here's an iron condor. I'm making all this money. I do this, 6 weeks at a time with a bunch of trades. I'm going to make 65%. And I'm sizing reward. They don't realize that this is a losing strategy if you have no risk management. It's just not. It's just like roulette. The house would win. So that's why you determine when we go to Houston. One of the big goals I have for the live event, because we'll have people there for 2 full days, is we're going to play with retirement in 10 years, 20 years, 5 years, 30 years. Everyone's going to get their time number in the whole room. And then we're going to start looking at percent return, and we're going to ask a question: what percent return does a person need to preserve their dream of retirement? And what type of strategies and so it's really up to the person at that point. Do I want to just get a dividend at 1%, 5%? Do I want to write covered calls and try to do better than that? Do I want to start doing these option trades and do even better than that? Then it puts the ball in their court and gives them the power to retire when they want, if that makes sense. So that's pretty cool. Bam, bam, bam. So there you have it. Back to you, Corey. Let me give you back can you just take it back?
Yeah. Yep.
Take
and
it
so,
back. Sorry for the tangent. Was that tangent allowed?
That was great.
Okay?
That was
Is that
fantastic.
an okay tangent?
And so when you think about, why this appeals to people, the iron condor, we just haven't had to do much with this trade, and that appeals to people, right? We just kind of sit back.
Yeah.
But it is a situation where you have a lot of sitting and letting that time decay work, and that's a lot of fun, and some of these trades just work from start to finish. But the profitability, really your ability to trade these types of strategies well is going to come in the risk management, like Andy said, because this is where you can't just sit and hold and hope and hope that, you know, tomorrow it bounces back and so on, because those risks might compound. And now all of a sudden it gets
Yeah.
worse the next day. And now you're like, well, I should have done something yesterday. Let's hope that it gets, and then it gets a little worse and a little worse. And a lot of people just think that I can put on iron condors, and the ability to trade an iron condor and just place that trade doesn't take a whole lot of expertise. But the ability to manage it is where that's where you need to have those tools. You need to know how to roll out, roll up, roll down, roll in. You need to know how to delta hedge with stock or with options. You need to know how to take it off. You need to know partial positions. And it might sound overwhelming, but each one of those is not difficult by themselves. It's just, hey, it's just adding a new multiplication, right? First, I learned my ones and I can multiply by one. Now I learn my twos and I learn my threes and I learn my fours and I learn my fives. And now I can multiply from 1 up to 5. And so you have to learn a few different things, but you've got that, you know, you've got your notes, you've got all that detail that goes into something like the ultimate options, where we go through every one of those scenarios. How do you do this? How do you do that? At what point do we look to do that? How will that change the structure of the trade? What do we do if our hedge isn't working? Well, here we would have a stop loss. Where do we put that stop loss and so forth? And so it's a lot of fun. I mean, the feedback we get from Ultimate Options is just
Good.
overwhelmingly positive. It's amazing.
Ron LaFond had an interesting question, you know, how many people are already retired? Because these strategies are, I mean, if a retired person were to do this without knowing how to manage risk, I'd be afraid they'd blow up their account. So it's really important to position size to risk instead of reward. And if you're already retired, you know, you're probably looking at income and preservation, you know, more than the growth phase at that point. You want to be very protective and have that stuff done. So I think what we'll do next week, that's a full, I mean, we did some tangents, but that's kind of why we do it live. You know, we had the question about price slice and we talked about deltas, and, you know, this trade is still in really good shape. But maybe we'll get lucky and it'll go down into that nasty area, and we'll pull out these guns, and instead of doing it theoretically, which we did today, we can do it actually instead of just theoretically. This is a narrow condor, by the way. I mean, if you look at, let's see where we're at total though. Let's move our price slices back to break even. Another nice thing about a price slice, you know, we're a 70% on this trade, and I will tell you the truth, you know, this is a pretty narrow one by our standards.
For sure.
I like to start this with like an 80 to 90 is where I like to start this. And, you know, 2 weeks in the trade, I like seeing, you know, 85, 95 instead of 70. So the odds are still in our favor, but you can see there's a part of that standard deviation now, that gray shaded area, that's in a nasty place. So this could be a beautiful education trade where it's probably not the best. It was too narrow for what we would normally do, but we kind of.
Well, what's interesting about it,
the upside, I thought the upside was the one that's going to get us.
We gave ourselves a better chance at showing some adjustments, because realistically, instead of selling this strike and buying this one, we might have sold this one and bought one down here, you know, and then we'd be sitting here in class going, well, now we're in great shape over here and we're fantastic over here and everything's perfect. It's kind of fun to have something where, hey, we're a little closer, and maybe we'll have something where we can actually put on an adjustment. And I don't mind the idea of closing some of this trade prior to earnings.
Let's take a poll of this. How many of you guys want to close half the trade, take some of our risk off the table right now, and think that'd be kind of fun to do? Is just say, hey, let's have some discipline. We're up. It's kind of looking like a threatened position, possibly. Here's where you play with your emotions. But what if it pops back up? What if we just, you know, what if tomorrow the market pops back up? See, those are the emotions you play with, right? You know, Sean says, is there a third option? There's like 20 different options we can do. We can do so many of these things. So look at this. Look at everybody. Let it ride. Show us how, but let it ride. Timothy is probably going to be the richest. He says, look, bird in the hand's better than two in the bush. No, don't take it off.
Boy,
Tangents,
it's about half and half. I don't know.
triangle, right? Reduce by 2 contracts. Plan your work and work your plan. See, Lynette's going to make money. All the guys like me, like P. Anderson's like me, let it ride, baby. I want the money, right? Daniel's like me, wait, man, let's not close. You know, Tom's like, take it off. So isn't it interesting that all of us have different opinions? And that's okay. All of us are going to have different tolerance for risk. All of us might look at this, and some people say, hey, $1,800 is a small position for me. I'm fine with this. Others like $1,800, you kidding me? No way could I, you know, survive that. So that's why it's very hard to say, you know, well, this is how it's done, because all of us have different emotions, tolerances for risk, stuff like that. So I love the comments here. It's not about the money, it's about the education. Let it ride for education purposes. Marina says, we women are more cautious, laugh out loud. Let's see this. I want to see the adjustment. So let's just show, I think this, it looks like the preponderance of people want to see what the adjustment would look like, but let it ride. Be pretty easy. We take some off the bottom half. First thing I'd say is, what half of this is killing us? You could take just the bottom half and leave the top, or you could keep it balanced and just take 2 contracts off. That's all you'd have to do. That'd probably be what I would do. Is I like to keep them balanced, but you could very much just leave the top where it is and just reduce your bottom half, because that's the one that's hurting you. Right,
And
Corey?
what you'll see is, if we do take off a couple of contracts, this will go down and this will go up substantially, of course, because now we're basically putting some profit in our pocket and eliminating hundreds of dollars of risk, but we're also eliminating some reward, right? So if you think about it, I think this is very educational.
Yeah, very educational.
I think this is good, because watch what happens. If I come over to Oxy and I right click and I click create closing order. Now we've got 5 that we could take off, but I want you to focus on this debit price and think about what that means. And then let's just say we were going to take off 2. If we pay 107, we collected 140, right? 1.40 credit is what we originally collected. We're buying them back for 107. So we're basically putting that 33-cent difference in our pocket. That's $33 times 2 contracts that we're closing. So we're putting a $66 profit in our pocket. But it does a couple other things. We just removed $5 of risk times 2 contracts. So we've taken our risk number down pretty substantially too. Not quite a 1,000, because again, we got some credit brought in, but basically we're removing a big portion of risk going forward. Our worst case scenario is no longer $1,800 after this adjustment. It'll be substantially lower. Now, our reward potential will no longer be 700. It'll be lower as well, because we're basically taking off this trade at 108. So we're taking about $216 of potential reward off the table. We're closing before that goes to 0, so we don't get to make that. Ideally, we would just sit in the trade and the 108 would expire away, right? And go all the way to 0 and we'd make that. So we are eliminating some of that. Now watch. If we confirm and send, and let's assume that this goes through. Okay, so it did at 108. We close it. Now watch what happens to this risk graph. Does it look a little different now? Because now we've only got 3 contracts going forward. That's fine. It's just the math of, we still brought in $1.40 credit. We still have $5 wide spreads, which means we still have 360 as our max risk, right? The credit equals our max reward. So we still have the same numbers. It's just all times 3 instead of times 5. And again, we put that 60 some odd dollars in our pocket, right?
So now our risk is not $1,800. Now our risk will be like 1,100, 1,200 bucks.
Exactly. It's the same trade. It's just reduced in size. So watch. Now we've got 1,080 at risk. Now we've got $420 left of reward. Same exact positioning, but just times 3 instead of times 5, right? So we've got a smaller sized position overall going into expiration. We put some money in our pocket, and now just a different risk to reward ratio. Well, it's the same risk to reward, pardon me, just different total amounts of dollars at risk and dollars of reward because it's times 3 instead of times 5. Very, very good educational example there of what that will do.
Fantastic. Ruben says, hey, I'm new, but this is really good. Good stuff. Purple line will get close to the blue line, but it's all proportional now, right? I mean, this graph is essentially the same risk graph. There's just less reward and less risk. We just, essentially it looks almost the same as what we had. It's just instead of having $1,800 of risk and $700 in profit, we have, basically $1,100 of risk and, a little less than $500 in profit. We just made the monster smaller.
We're still in a 140 reward per spread and 360 risk. That did not change. It's just that instead of it times 5 contracts and times 5 contracts, now it's times 2 contracts and times 2 contracts. And it's actually better than that if you think about it.
We're times 3, I think.
Oh, times 3, pardon me. And if it's better than that if you think about it, because of what?
We've already
put some. So if we put, I don't remember, was it $66 or $68 or something?
Yeah.
If we put $66 of profit in our pocket, we've already locked that in essence, right?
Yep.
So we made that money. Well, really, this doesn't show it because that's a realized gain, but we have 1,080 minus the $66 in our pocket as max risk for this trade. We have the potential to make $420 plus the $66 of profit that we put in our pocket. So this is what we call a realized profit. We've already realized this portion. We have 0 risk and $66 of profit.
Yep.
And then you want to see something fun, we could say, well, if we made $66 in that portion of the trade, we could actually come over here and buy a share of Oxy that we could own forever, right?
Yep.
We could go buy a share that would cost us $58 with our $66 of profit, and that one share will pay us dividends for the rest of our lives, and
our children's lives. Yeah,
exactly. So that's
cool. How and we just in essentially you just added to your asset column and built your asset. And just think about this: what if you added a share of Oxy to your portfolio every 2 weeks? In 2 years you now have 100. And now you could write covered calls on that. I mean, it just compounds. It's like acorns that turn into oak trees. When you think of it that way. And people look at a little acorn and say, well, that's not enough even to feed a squirrel. But an oak tree will feed the whole squirrel's family forever. I mean, the potential of compounding is just incredible. So great, Mana Club, great quick start lab. I mean, really
so
fun.
Much fun. What a great group.
Right.
What a great group.
I'm new and in the 4 pillar stage. Today's webinar somewhat over my head. It's full of great info. I learned a lot. Thank you. Well, great, Rick. Good to have you here. It's a quick start lab, so it is a little breakneck speed. It is quick, but what's exciting about each quick start lab is what we hope is that people get illuminated to what the possibilities are. It's so interesting how people get down because they feel they have no opportunity. and they feel they have no chance. You know, oh, Amazon's going to crush everybody. We'll buy some shares and join in, right? Oh, Apple, these guys are all written. We'll buy some shares and join in. And people say, well, I'm enough money to buy shares. Well, you know, this is pretty good ROI we're looking at right here. It does have significant risk, has wonderful probabilities, but we can manage these things. And with experience, with great mentors, with great classes, there's opportunity for all of us. There really is, to manage these risks. And it's a beautiful world we live in, you know, marvelous world we live in. Okay, thumbs up, thumbs down. Did you guys get value today? Did we do some good stuff here today? Was this fun? Let's see this. Yeah.
Love it.
Yeah, I love Sean's comment here. Great stuff, great class, a lot of fun. A few tangents, and that's okay. We had a plan that kind of went out the window. We'll do it next week.
This was better than our plan anyway. So you got some really good stuff today.
Yep. That's one of the reasons that the one advantage of the live class. It's also, I'm going to keep encouraging you guys to come to Houston. I think a lot of people don't realize that, like when I start, people don't understand how those live meetings affected my life. Like people think, oh, it's a seminar or whatever. No, these are things that transform you. I've been in so many meetings where I've been there long enough and intense enough and been around the right people that the entire trajectory of my life can change. I mean, you can literally go to a meeting like this and walk out with an entirely new trajectory. And that's why I love teaching them, and that's why I love going. So if you haven't gotten a seat and secured your seat for Houston, really give that some thought, because you're going to be around people that are like-minded, and the questions that will come up there will be a lot like this. We're going to leave a lot of time for flexibility. Obviously, we have an agenda and we have things we're going to cover. But we're going to leave a lot of time for flexibility, and the person that is just like you might have just asked the question that you needed is so valuable. So if you can get to Texas, we'd love to see you there. It's going to be a lot of freaking fun. So great questions, great comments. I'm glad you guys weren't worried about the tangent. Sometimes you get personalities like, I want the agenda and I want to check every box in the agenda. But when someone asks a great question, it's worth a departure to do that. So in fact, I like the adjustment we made educationally. To tell the truth, I wouldn't have made the adjustment yet. You know, I would have stuck with it because I'm so far from the theta switch. If you think about that adjustment, that's a chicken shit trade. That's a chicken trade, because if you look at it, was time decay working for us? Yes or no?
For sure.
Was the fact earnings would cause a volatility crush working for us? Yes or no? Right? Was the delta at a point where we were even losing money? No. But it's kind of unfair because we know if it does get in the Bermuda Triangle, we know how to delta hedge it. And there's really there's not this thing. This trade's going well. It's not on fire yet. Would you agree?
For sure. Oh yeah, for sure. Yep. The only potential that I see is really the earnings. I mean, that's obviously a little bit of a wild card where a gap could occur, but otherwise, I mean, we're sitting pretty. You can't really expect in these trades to constantly sit right here at the perfect point. That's unrealistic. Of course it's going to move, and we saw it move this way for a time, and then it came back this way, and now it's gone a little bit this way too far, and it very well might go right back up in here. And so, yeah, I mean, I would tend to agree. I don't think we would have closed just for the sake of closing, but I think it's a good educational exercise to get people thinking through well, what if we closed half of the position, right? And we still have, I mean, we're doing this all for education. This is a paper trading account, first of all, but there is still the 3 contracts. So we still have that hope that this thing goes against us and comes this way on earnings, so we can show some other adjustments. Hey, what if we delta hedged this way? What assets would we use? We could short some Oxy, we could buy some puts, we could do a variety of different things. What if we rolled? We still have 3 contracts. Maybe we roll one for educational purposes. And so there's a lot of things that I think we can still show. And that's part of why we started with 5 as well, is to show a variety of different possibilities. So fun stuff.
Okay, fantastic. Quick Start Lab, great comments from everybody. Let's see this one. Someone says, one of your best tangents ever was in Meta Club, where we went off on hidden fees of 401k. Well, don't put a nickel in me there, Ron LaFon. We'll go another hour with that. Venue in Houston. We just have a really nice hotel down there. We have a rate. I don't know if we have rooms at this preferred rate yet, but it's not bad either way. Very good stuff. Okay, all right. Ken says, I love the call out on his chicken trade there. So we've done chicken trades before. Okay, we'll see you guys next week. We'll do some directional stuff. We'll get back on track. Have a good one, everybody.
Bye, everybody.